I'm really excited today, guys. First, a big thank you to LMAX Digital for sponsoring this. David Mercer, of course, is the CEO of LMAX Group. Just a couple of words about LMAX Digital. So LMAX Digital was launched in 2018 by LMAX Group, which is the operator of regulated FX execution venues to take advantage of strong institutional client demand for crypto trading. Today, LMAX Digital is the leading institutional spot cryptocurrency exchange. They have a global institutional client base with over 350 institutional clients, including non-banks, funds, and brokers. They've experienced growth of over 400% and a 2-year volume CAGR. And actually, they broke a whole bunch of records in November with notional volume being over $15 billion in the month of November, which is just absolutely stunning growth. I'm sure we're going to get into that on the talk today, but a huge thank you to David and the folks at LMAX for making this possible. I'm really excited to be joined by 3 of kind of the leading luminaries in our space, especially from a markets perspective. This is a really interesting chat because we've kind of got great representation from the different firms of David and Michael and Sam. So guys, if you wouldn't mind just doing a quick 30-second intro for each of you. David, I'll pick on you to go first, especially since I just took all your talking points there. So I'm gonna make it difficult for you.
Another advertorial. So, hi everyone. LMAX Digital was the 5th exchange that LMAX Group launched, as Michael said, about 2 years ago. Primarily, we're an FX exchange group. We trade about $20 billion a day of foreign exchange in London, New York, and Tokyo. We get offices in 12 countries and customers in 100. So with LMAX Digital, we've been very happy with the launch. Primarily, we're focusing on the institutional segment. We're trying to help the overall ecosystem in crypto land, primarily so that established capital markets players, funds, hedge funds, banks, brokers can exchange risk with like-minded participants. So to do that, we just brought our exchange technology to the crypto space, and so far so good.
Michael, calling you next.
Great. Hi, everybody. And I echo Mike. I'm a big fan of the Blue Oyster Cults. So great music choice to kind of kick off our webinar. I'm Michael Moro. I'm the CEO of Genesis, and we are a crypto prime broker. We opened the institutional over-the-counter trading desk back in 2013. Then we launched our lending business, Genesis Capital, in March of 2018. And then just a few months ago, we acquired our UK custodian called Volt. So now we are the leading institutional trading, borrowing and lending, and kind of the custody services, all under the Genesis umbrella. We're headquartered in New York, but we have offices now through the acquisition of Volt in London. And we'll also have a presence in Singapore as well to round out our global offices.
And last but not least, Mr. Sam Bankman-Fried.
Hey, yeah, thanks for having me. So my name's Sam. I'm the CEO of Alameda Research. It's a crypto quantitative trading firm, and FTX, which is a crypto derivatives exchange. And Alice founded 2017 and is a sort of general purpose liquidity provider in crypto, doing a combination of market making, arbitrage, liquidity providing on exchanges for tokens and other things, trading $1 billion a day across most of the exchanges in the ecosystem. And then FTX, which is founded in early 2019, is a global crypto exchange, sort of derivatives first exchange, though with the growing spot market as well, which has been trading a few billion a day of volume. And I've also recently been pitching in with Project Serum, which is a decentralized ecosystem built on Solana.
Excellent. Awesome, guys. Well, thank you again so much for being here. I'm really excited to kind of dive into this discussion, which today we're going to be talking about spot trading and liquidity. I think just to get started, it'd be great to get some context and thoughts from all of you on kind of the recent rally that we've seen in Bitcoin. So obviously it's been a big year for crypto as an asset class, with Bitcoin sort of leading the way. I think a lot of people in the crypto space tend to love the sort of headlines. So we had the CEO of BlackRock, Larry Fink, talking about how there might become eventually a global marketplace for Bitcoin. We've all probably paid attention to Paul Tudor Jones and Stan Druckenmiller talking about this asset class, which has led a lot of people to say that the rally this time is different and it feels more institutional. So I'd like to get all of your thoughts on, do you agree with that statement? Is it an institutional base of demand that's driving this rally? David, I'll pick on you first here.
Everyone expects me to say yes. I think so. I think somewhat. Look, I think first and foremost, everyone in the, in the crypto marketplace should be congratulated for the performance in 2020. I mean, what you've seen, particularly with Bitcoin, is an amazing resilience of that product and of this asset class throughout it. So, yeah, if you look back in March, all these charts are showing capital markets assets going to zero. Bitcoin looked like it was going to zero, right? But it didn't. It stopped around high 3,000s, 4,000. Oil went to zero and beyond, right? That's right. People paid you to take oil. So I think that everyone in the institutional segment started to take note and say, hey, this should have gone to zero. It didn't go to zero. In fact, it hit a floor and started to rally from there. So certainly, look, all the big names talking about it have helped. You're still not seeing huge banks entering the space yet. But I mean, I spoke to two bulge bracket banks just this week. Very different viewpoints. One, I'm positive will enter the space in 2021. One may not enter it ever. That's what they say at the moment, but I think that might be different in 2025. But certainly, if you imagine those names you mentioned, the fund managers you mentioned, there is $100 trillion of assets under management in traditional capital markets today. That's just a fact. 60 trillion are actively managed. So if you imagine 1% of those, so 1% of everyone's portfolio went into crypto assets. And I think that's what we're talking about. Everyone, who's not born and bred crypto evangelist is going to say, maybe I should have 1 to 3% of my assets in somewhere in crypto. So 1% of 100 trillion is $1 trillion. It's 3 times the market cap of Bitcoin. So certainly there's been some of it. But maybe we should listen to the more of the evangelists, the younger guys like Sam. They've been telling us this for years. Why do we have to listen to the old guys in capital markets? They've had their time, right? Now it's crypto time. So, but certainly I think it helps. And I, for one, certainly believe it's coming.
All right, well, Sam, you've been singled out as a young guy here, Mr. Evangelist. So love to get your opinion on this recent rally as well.
Yeah, I mean, some of this has been institutional. I think that that's totally new. I think that this is not, this rally hasn't been nearly as crazy as the late 2017, early 2018 rally is, but it has brought in more institutions. And I think that there's, it was sort of weird how quiet it was this time that it happened. Like it was sort of for all the talk and bluster, 2-3 years ago about institutions coming in, it sort of was almost quiet that like one by one, actually a bunch did start dipping their toes in. But as David said, this wasn't a deluge of them. Like it's not like you have Walmart saying that you can now, they've got a QR code so you can buy Bitcoins or whatever at their stores or something like that. Like this is sort of Bitcoin adjacent businesses, the sort of like most natural ones who started moving a little bit in that direction. I think PayPal is a good example of this. It's like exactly the type of business you would expect to like have a quarterly meeting where they just discussed whether they wanted to add digital currencies. And like for the first time, they sort of decided yes this time. And there's just like a bunch that are sort of in that category. And you can see, similar things with like the growth in GBTC, with the growth in LMAX's volume, and just sort of generally with institutional facing products not having this sort of like unbelievably explosive growth of like, oh wow, like this is everyone coming in, but just having like really strong growth. And so I think that this was a semi-institutional rally, and I think that's sort of big and new. Although again, this wasn't the world going all in on crypto. This was one step in that direction. There's another half of it though, and that other half was not retail, which I think is sort of interesting. The other half was like very much sort of like the true believers of crypto. It was very much people who have been plugged in for a while, people who've always held crypto just buying even more. And I mean, you can sort of see this if you just go on, any social media platform and look for like crypto heavy accounts. Like everyone was bullish, and everyone was talking about getting leveraged long. And I mean, you could see open interest going way up on futures, and even more telling, you could see liquidation rates going way up on futures, and including completely insane things like times when there are liquidation driven moves and open interest net increases, which is sort of an interesting thing to mull on. But basically, this was sort of driven by a combination of like, a few institutions starting to move in, and a bunch of just crypto believers getting even longer crypto. And it's sort of like a very different dynamic and much more concentrated than the sort of like, late 2017, you just bump into someone in the mall and like they're probably going to ask you about Bitcoin because what else are you going to talk about?
Yeah, it certainly did seem to be everywhere. So that's very interesting perspective. So maybe a more institutional rally, but also kind of driven by that core believer base. So maybe the thing that's really going to put us over the edge here, and David, I know this is something that you've said in the past, is really this market becomes institutional when the banks get involved. Why is that category of institutional participants so necessary to move the space forward?
Hey guys, sorry about that.
Hey, Michael, welcome back. So why are the banks important? And look, before all the believers as Sam profiles them and the evangelists out there turn off, look, I think it is important for the real money segment. Okay, so that 100 trillion under management, for those pension funds, those asset managers to come in, they need some sort of credit intermediation. So it doesn't mean actually that the bulge bracket banks have to be believers. And I'm not going to give them more press inches. A lot of people calling out Bitcoin and saying, it wasn't real, blah, 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 a couple of years ago, at the same time, dealing it for their customers. That's the reality. The banks today hold these customers and they need credit intermediation, and they're not going to go to the retail exchanges and place hundreds of millions of dollars or billions of dollars of assets with those retail exchanges. They need a way to intermediate it, and they need somewhere to hold their funds safe. And ultimately, it's going to be either someone's going to break out of the pack and become a big institutional safe haven quasi bank, or it's going to be the established players who are trusted with all the other $100 trillion of assets. So that's why it's so important. I mean, it's the middle crux of my triangle, my ABC triangle of adoption, banking, and credit. So I think that's what's required to see a real explosion in the crypto market and to see that everyone in the world has part of it in their portfolio.
Absolutely. And I think we've gotten to a core part of the discussion, which is just access panels to crypto, right? And I think a lot of people don't fully appreciate how amazing it is that crypto has grown even to the relatively small size that it has without any of the traditional distribution channels that financial products typically enjoy. I want to turn this over to you, Michael, because you're building a prime brokerage business, right? Which primarily allows access to institutional players in this space. David sort of just brought up credit. Can you talk a little bit about the role of credit in your business, and also sort of what the introduction of the larger institutional players, the banks, would mean for you?
Sure. When we have conversations with institutional investors, sure, they care about spreads and liquidity kind of on the trading side. Sure, they care about security kind of on the custody side. But the number one topic they lead the conversation with is credit. It's how much leverage, what will you lend, what's your balance sheet capacity, what are the rates? And that really kind of dominates probably 75% of an overall conversation when we kind of look to onboard and kind of start to get involved. And I think a large part of it is, one, it's newer as far as a product or service to be offered to institutional investors. And two, scarcity is a real thing. And not just kind of on the, the availability of credit in crypto is still relatively scarce, which kind of leads to sort of the higher interest rates that you kind of see when we talk about lending and borrowing businesses. And why can I earn 8, 9, 10% on my stable coin, but I can't, I'm barely making basis points on my treasury. And so, credit is an incredibly important thing. But we're really just kind of getting started. If we think about how long crypto's been around now, how long trading's been around, we were the first guys to kind of do this on the credit side. It's 2.5 years. On a relative size, I mean, the Genesis loan portfolio's just north of 3 billion today. The Bitcoin market cap is sitting at 350 billion. We're talking, less than 1% here of just kind of the Bitcoin market cap in terms of overall support and how much liquidity is kind of available. And so it is a key component. Now, how will the banks get involved? Certainly, if the banks start lending into the space, my first bet is actually that that actually invites more demand. You would think kind of making the supply pipeline kind of bigger with lower interest rates. I actually think the validation of the space and kind of continuation of it will actually raise interest rates, or at least keep them steady for some time before kind of the trillions of dollars kind of flow in, which will certainly normalize interest rates to much, much lower. My guess is it'll kind of get to there to kind of the equivalent asset classes on a risk adjusted basis. But I think that is yet to come. And I think that's part of the excitement, right? I think a lot of people feel they missed the trade somehow. To your point, all of this has happened without it. And so I think that's kind of the growth potential. Certainly asset classes is still yet to come.
Michael, actually, can we just double click on actually something that you just said, which is one of the things that does tend to grab headlines, or it's a question that we certainly get a lot, which is, how is it possible that you can earn such crazy interest rates on some of these assets, right? It's like, if you go on to something like BlockFi, it's almost 9% that you can earn on stable coins. Can you talk about what exactly are the mechanics that, what about the availability of credit leads to interest rates, which I think would raise a lot of eyebrows sort of from traditional finance, and how would the inflow of more capital sort of regulate that?
Sure. Part of the Sam is laughing over there because FTX and kind of the futures curves have a lot to do with the availability of why interest rates are so high, right? For one, there's not a lot of capital lending into the space, and so they can be somewhat like price setters. And two, when people borrow that asset at 9, 10% a year, can they kind of beat that in a market neutral type of way? And that's kind of the crux of kind of the basis trading that you'll see a lot of our institutional clients doing. And especially kind of overseas where you have access to kind of the FTX, kind of the liquid markets. You have guys that'll, arbitrage between the spot market and the futures curves. When in a bullish regime that we've kind of seen this year, you kind of get the ability to earn 20 to 30% on an annualized basis, just trading, the spot and the futures curve. And so paying 9% a year to be able to make 20 without kind of taking a directional bet is a trade that most, professional traders would sign up to be able to do. So I think Sam actually for the availability to be able to kind of trade that and it kind of.
All right, Sam. So the next time I get asked this question, I'm going to direct it to you. I think you will. Any commentary on what Michael just said?
Yeah, I mean, I totally agree. And I think that there's sort of two ways that you can approach a question like this. And one is sort of the most proximate way, which is you can say, okay, well, futures interest rates are often above 8% annualized. And so, yeah, I mean, if there's sort of an arbitrage you can do making, 15% a year, then it's sort of not shocking that you see interest rates that are like a decent fraction of that. I think another thing that you could do is try and trace back to the very beginning and say, how did we end up in this place? Like, how did the industry end up in a world where interest rates and, futures curves and yield and all of these other things often are, 5 times what you see in traditional finance? And I think that there's like a few answers to that. And maybe I'll just sort of give two, but I think there's a lot going on here. One of them is, and I think like a big part of this is, which is something Mike mentioned here, is bullishness. Is like, one place all of this traces back to some extent is, a lot of people think that Bitcoin's going to go up more than that each year. A lot of people think Bitcoin's going to go up 30% a year. And of course, this year it's gone up 300% or whatever. And I guess not from the start of the year, but and if you have a significant fraction of the entire industry that thinks like the fare for Bitcoin a year from now is twice the fare for Bitcoin now, or half higher or something like that, then you have an entire industry that's willing to pay high interest rates in order to be willing to get longer Bitcoin synthetically. And obviously not everyone's going to go put on leveraged Bitcoin trades or something like that. Like, it's not that direct, but that's sometimes where a lot of this flows from. And then you get all this flow through effects where so many different weird synthetic trades are priced given that assumption. And that sort of like creates a lot of different curves here. And you have things like, lots of participants aren't willing to get shorter Bitcoin unless they're going to get paid a lot to do it, or aren't willing to sell their future Bitcoins unless they're going to get paid a lot to do it. And that's where you can start to see this funnel like really start to open up if there's just no supply of future crypto at less than, not, if there isn't significant supply of future crypto at less than significantly higher prices, right? Then all of these things start to blow open, all of these spreads do. And so I think that's one side of it. And you have on this other side this weird mirror of it, of people who are not willing to buy future crypto at anything more than half the current prices, which is not obviously the typical like crypto believer, but instead it's, maybe it's someone who accidentally has crypto on their balance sheet and they're like, what the fuck is this? I don't want this on my balance sheet. Like, my bank doesn't want this. My investors don't want this. Get this off, like, get this away from me. And they're willing to pay a lot of money to not have any current or future crypto anywhere near them. And then you get blowing out interest rates in the other direction, right? And then you can sort of like ask a second question, which is, okay, sure, there's sort of this pressure, but why isn't there supply? Like, why doesn't supply just jump in and close down all these spreads? And I mean, part of the answer is like, I don't know, that's sort of what's starting to happen. That's what a lot of the people on this panel are doing. But but I think another piece of this answer is like, it's hard. It's a lot harder to do this than it is to close down a NYSE versus NASDAQ spread. And the reason is like, the like all the biggest balance sheets in the world have connections to NYSE and NASDAQ, and they have a single prime broker clearing both of them, and they settle to the same symbol, every couple days, and just automatically cancel out, and they get effectively infinite margin for a spread between them because they're not even considered a spread. It's just the same settlement symbol. And so like, of course, you get paid a BIP to do an arb between NYSE and NASDAQ. Like, there's $1 trillion of capital that's willing to put that on. You look at like, a Bitcoin future against a Bitcoin spot market, and I mean, it's geez, like, you'd have entities in 2 different jurisdictions. You get no margin treatment that recognizes the offsetting risk of the two. So you have to post capital for months in both places. You have liquidation risk because there's no such thing as like generalized prime brokers yet in crypto, even if you're hedged globally. Maybe one of the exchange shuts down with withdrawals and you can get your money out. And it, like, you just like start going down this laundry list of like things that make this trade hard. Your bank shuts down your bank account because you sent too much money to Coinbase and they don't like crypto, and like all of a sudden you're sort of like, oh geez, like, it's sort of miraculous anyone gets this done, I guess. And so yeah, there's a lot of demand for large interest rates in various directions depending on market sentiment, and the supply is fighting through infrastructure that is like cobbled together out of sticks and stones to try and provide liquidity to it.
Mm. So I think, Sam, that was a great explanation of some of the quirks, right, about this space. And there's a lot of really weird stuff when it comes to crypto market structure. It's been fun to sort of watch this new capital market structure being built in real time. Some of it mirrors or mimics traditional market structure. Some of it is very different. And I want to dig into some of those differences a little bit in a second. But David, I'd love to get your opinion on this because you just mentioned 2 talks with bulge bracket banks. One of them you're very confident is going to move into the space. One is potentially never going to move into the space. So some of these things that Sam are bringing up, depending on the lens that you look at the world through, they're incredible opportunities or just insane risks, right? That it's like, look, I can earn these interest rates, and that feels very shiny and interesting in a world where there's everyone's sort of chasing yield. But it also sort of makes you think, wait a second, how does this actually work, or how is this possible? And we're talking about 9 and 20% interest rates, but that's not even getting into the DeFi stuff where there's like the yield farming and all that crazy kind of 1,000% yield that you might get. So I'm curious, David, from how do these sorts of conversations go? Do these institutions view some of these quirks as opportunity, risk, something in between, or does it just differ based on the institution?
Yes. One thing you miss with all these interest rates. By the way, all the interest rates are too low. Okay, you come from an old credit guy here. The key word you're forgetting there, everything Sam threw in at the end of his answer there, effectively goes down to credit. 9%, 10%, 20%, too cheap. You're looking at a guy that bought Russian government debt at 100% yield for one reason only: credit. So the currency devalued every year at the time at around 20, 30%. All of a sudden you've got 70% excess credit. Oh, excess interest, brilliant. Big credit risk. And actually putting your money to work, it's very capital intensive to capture this ARB that everyone calls it right now, or this credit spread. I call it a credit spread. So I'd say it's pretty cheap right now in what is now a traditional asset in crypto, being Bitcoin, and it may not even be expensive enough for the DeFi world. But in terms of what's the institutional segment looking at? It comes down, they have a few barriers, and the big barrier, I know you're going to touch on it later, is regulation. It's not quite regulation, it's just AML. Okay. Everyone has to sign up to global AML guidelines. Very simple. Every country in the world that matters is signed up to FATF guidelines. Some of the other derivative exchanges under pressure haven't abided by those guidelines. They have to. So if you're sitting there in a multi-billion-dollar organization right now, if there's a risk you're going to touch a tainted asset, you can't touch it. So where they will touch it first, actually, will be in the derivatives, because their customers want the economic interest. So that's a big barrier. And it actually, believe it or not, there's still a lot of, at times, disbelief that there's actually demand. So one of the bulge bracket banks I discussed said they actually don't have customer demand right now. And they facilitate the demand they have through institutional futures. I think that's going to change, but the big barrier, make no mistake, the technology is not a barrier. It's absolutely no barrier. They can trade every single one of these products now. Distribution, demand from their customer, that's a barrier. The regulation from their existing regulator, are they allowed to touch it? That's a barrier. And then, of course, they have internal board policies. That's a barrier. But in terms of actually touching these assets, trading these assets, borrowing and lending these assets, no barrier. And the place where they're going to start is the storing of the asset. Once they know they can store the asset for their customers initially, once they can speak to their customers and say, your asset is safeguarded and I'll only trade with bona fide counterparties, then that barrier will be gone. So, it changes, and believe it or not, I mean, we are only 12 years in. You're still fighting an uphill battle with some institutions to convince them that this asset class is here to stay. But compared to, say, 2 or 3 years ago when we launched LMAX Digital, I'd say I'm fighting fewer of those battles, and more people are at least connecting or taking the market data because they are seeing the interest from the customer.
So you briefly touched on this, but I do now want to get into regulation. And regulation is a topic that everyone loves to talk about. You got to talk about it. Ever since I've been in the space, it's kind of come up on these panels. But I think over the last couple of weeks, even you've seen a lot of pretty interesting announcements. This one was a little while ago, but everyone in the industry kind of looked up and paid attention when the CFTC went after BitMEX, which is obviously one of the oldest derivatives exchanges in crypto. I'm curious what all of your thoughts are. Do you think we're going to see more actions like this? And Michael, something that we brought up even before this, but Coinbase recently disabled margin trading. Is that related, do you think, to the CFTC enforcement against BitMEX?
Yeah, I mean, I think the closer analog, I think, to the BitMEX situation was kind of the Bitfinex action that the CFTC took a couple of years ago regarding what constitutes sort of good delivery on kind of the margin trading that was enabled on the Bitfinex platform. Because Coinbase, the way the CFTC views it, if you buy coins on margin on Coinbase, you can't withdraw it. It's just a balance kind of sitting in your account without the ability to withdraw off the exchange. And it's the withdrawal that they're constituting as actual delivery. If it's encumbered and you can't get the asset off the exchange, then that is not good delivery. That is actually a derivative product. And therefore, this is kind of subject to the CFTC oversight. And I'm sure that while Coinbase is trying to figure out how to deal with it, certainly on a retail focused kind of mass user base, trying to ascertain credits and kind of doing the, is this a credit worthy enough counterparty to be able to extend margin to and let them withdraw off the platform. And still make good on their margin loan. That's a lot of work, right? So until they kind of figure out how that works and if they can figure it out, I think that's probably the primary reason why they're turning it off. And frankly, part of our challenge, is that the rules around the world are not uniform, right? Here we are just kind of talking about the U.S. and one branch of the U.S. regulatory. The SEC has a different view. We have the CFTC, and then obviously Genesis is located in New York, and so we have our DFS issues with the state of New York regulators. And we're talking about FCA registration. There was an article that says it's 150 companies still waiting for a reviewer to get assigned for the applications. Singapore put out new guidance earlier this year about kind of getting licensed properly there. And the fact is, all of this kind of regulatory stuff is happening all around the world, kind of concurrently. And trying to navigate a business with kind of global clientele and knowing the nuances of how does that country look at this and how does that branch of that country look at this versus another is a massive challenge. And we talked about why is this so different than kind of traditional asset classes? That's one of them, is kind of navigating through these regulatory hurdles to stay compliant. Because at the end of the day, that's what our clients care about. Our clients are ultimately like, are you registered? Are you licensed to do what you're doing and to be able to serve me? That's part of an onboarding check with these institutional investors, and being compliant with all of them is really, really, is kind of the name of the game for you to become a liquidity provider.
Absolutely. Sam, I'm very curious to get your opinion on the recent CFTC action. Not to put the screws to you here, but I'd love to know what your thoughts are.
Yeah. I mean, I sort of feel compelled to start off just by saying that it's and BitMEX is a real institution in the space and really sort of a defining a defining place really in crypto for a very long time, and I think probably brought the space forward quite a bit in terms of regularizing margin and derivatives. And I think that in a lot of ways, the way that they built that part of their exchange, I think was actually better than what a lot of other attempts were. and set actually good precedent in some ways, I think, for this space. Although there are a lot of things they had to contend with, including just massive liquidation sizes, which was kind of constantly stressing their liquidity base. I think that like when you look at these enforcement actions, and I think similarly when you look at like regulation, like the Singapore sandbox, and a lot of other similar things, from sort of like a very distant view, there's this obvious take, which is like crackdowns are coming and regulation is coming, and like I think that take is not crazy, but I think that I wouldn't really call it correct. And I think that like it's sort of this classic thing of like taking what's actually really detailed and nuanced situation that just completely hangs on specifics and abstracting all those away and just sort of like trying to draw broad strokes generalizations from it that don't necessarily work. And I think that like and that's not to say that like there's no crackdowns coming or no regulation coming. I'm not trying to make that point either. Just that like I think it's easy to overgeneralize from these. And like I think if you look at something like a lot of the recent enforcement actions, and especially if you read the actual reports written by governments on these, like you don't see enforcement action that says this was a Bitcoin related venue, thus we are cracking down hard. Watch out, everyone else. Like that's very much not what they see. And like I think if you read it, it's like really surprisingly human what you see coming through from the other side. And you kind of read it and you're like, oh wow, like a reasonable human person wrote this. That's like not what, that's not what BuzzFeed describes legal actions by the government as. But it's true. I mean, these are real human regulators on the other side trying to do reasonable things. And you see a lot of paragraphs where you're like, come on, guys, this is fucking egregious. Like really, like this is how long it took to do this thing. Like you didn't even like start to do this process. And it's like the whole enforcement actions are sort of like they sort of really do read as one long like Jesus, like really, like of course we have to fucking enforce something here. And I think that you sort of see this all over the place of like just bad fact after bad fact after bad fact after really embarrassing fact listed out, and you sort of get to the end and you're like, oh, how the hell did it get in this place? Like, how did we end up here? Like something must have gone wrong 2.5 years ago, because this isn't an overnight surprise. Like this has been brewing. And I think that like that's just like a really just pervasive and important fact about regulation in general. And that I think it's like easy to forget is true. But when you start diving into these, it's just like really important. And like, I think it's also sort of an interesting thing about talking to legal counsel. Like if you get bad legal counsel, what they'll do is they'll say like, we read the regulation, absolutely feel 100% free to do this thing, as long as you don't do this little thing, because if you do this thing, you're totally fucked and you're going to jail tomorrow. And like, there's like times when that's the answer, but it's like almost never the answer. Like it's almost never the case that like the difference between going to jail tomorrow and absolutely totally free is like some small detail. Like regulators aren't going to look at that and be like, oh yeah, obviously you can never investigate that thing at all, but that other thing, you're fucked. Like that's just not how it works. And like, the real answer is sort of like is this like an important piece of this was like, were these generally reasonable actions attempting to be reasonably compliant given the circumstances, or were these like egregious, just like throwing your middle finger up at regulators? So I think that's just like a really important context for regulation in enforcement actions. And then I think similarly, when you look at these regulatory sandboxes coming out, and I think this has been referenced with like this giant wait list for the FCA one, it's easy to see, oh, there's a sandbox coming out in this country. Crypto is now regulated. Everyone's going to move there and be sandboxed. And like the actual answer is you read the sandboxes and they're like, if you happen to be a business where your entire business line is offering OTC trades for Bitcoin versus wire transfers in this currency to accredited investors in this country that are done under these circumstances with no credit, then you can apply for a sandbox and we'll talk, and you start reading, you're like, that describes like 0.3% of all businesses in crypto that could even plausibly fit within this sandbox. And it's not that the governments are being absurd, it's that like crypto is a gigantic, messy space, and it takes governments a long time to build out entirely new regulatory infrastructure for all of it, and they're starting somewhere. This is not like regulations is like, it's not like all the regulations now here, it's all final. It's like, this is a start. Here's a sandbox, like it's called sandbox for a reason.
Sam, if I may, there's
yeah.
two different things. Let's just be clear on that, right? So two different things. One is Financial Action Task Force, AML.
Yeah. Oh, sorry. Completely agree. Completely agree.
I mean,
yes.
There's a lot of this, a lot of what we talk about, and I don't want to talk about any cases and enforcement actions. A lot of it's just breach of AML guidelines. Okay,
Yeah.
so anyone in capital markets has to abide by that. That's one part of it. That's not regulation. That's AML, right? That's so that we don't support criminals, terrorism, all that good stuff. And every country in the world, more or less, apart from people you don't want to deal with, are signed up to that. So that's what a lot of, let's not confuse that with regulation. Now, incidentally, generally regulation is a good thing. And the regulation that people are talking about is mostly to protect retail investors. So LMAX Group, I'm regulated heavily in the UK by the FCA. If I was to sell to retail customers, they have to pass a suitability test. So do you understand this product? Have you traded it before? Is this leverage suitable for that customer? Most of these crackdowns, everyone talks about regulation, are about protecting retail customers. Now, generally, incidentally, I don't think that's a bad thing. And if you go, even just look into leverage in equities, the SEC has basically said, unless you're wealthy in the US, leverage isn't for you, right? So CFDs that are prevalent in UK and Europe can't be traded by private investors in the United States. Accredited investors can trade that. So those are the clampdowns. No one's really outlawing spot trading anywhere, and no one's outlawing wholesale trading. So all the headlines say FCA bans crypto. No, they didn't. They banned leverage for private investors. If you're not a private investor, you can trade on leverage. And if you are a private investor, you can still buy the spot product. You can still own the asset. So I think this clampdown everyone's seeing is two parts of it. One, are you complying with global anti-money laundering guidance and legislation? Two, are you selling to retail? If you are, abide by these guidelines. That's what you're seeing happening in the market. So we shouldn't be too emotional about it. And I don't think we should particularly be helping people write the guidelines. I'm heavily regulated in 5 different jurisdictions. And as of today, no one has said to me, David, you can't be selling spot Bitcoin. And no one's even said you can't be selling a Bitcoin future. So that's where we are at the moment. But to Sam's final point there, it is an evolution. We don't yet have a framework. So I'm regulated. LMAX Digital is regulated in Gibraltar. Why is that? Because the FCA said, hey, David, we haven't got a framework for a crypto exchange in the UK. So yeah, by all means, go to Gibraltar, because we don't have a framework for you to operate right now. To Michael's point, some customers say, hey, are you regulated? In fact, in the wholesale environment, I'll tell you something, not one customer yet has asked me if and where I'm regulated, because basically they look at the group behind me and they go, yeah, you're good. So I think we just need to be calm about what's happening. There will be more regulation. But one thing I'd say to all the crypto evangelists out there and all the young guys starting up platforms, exchanges, new products, please, please, please abide by global AML guidance.
Yeah.
Because I don't want anyone else to have an enforcement action against them. Abide by that, and then let's all grow this great industry together.
Yeah, totally agree. I should have made that way more clear. Like some things are just way more developed and understood and serious, and AML is one of those. That's a department that takes what they do very seriously, and there's obviously still lots of gray area there around like exactly what is a reasonable action there and what isn't. It's not like, but that's the sort of thing where you do an egregious thing on AML, and that's not good.
Correct.
Absolutely. So moving beyond regulation here for 1 minute, and just a reminder here as well that I want to move on to audience questions at one point. So if you're listening and you've got questions for these guys, now is definitely the time to ask it. But I want to look to the future for just 1 second. It's been a really interesting year for this industry overall. You know, David, I'm looking at your business, right? I know, I listened to the podcast that you did with Frank over at The Block back in May, and you're talking about hundreds of millions in volumes. You did over 1 billion in volume in 1 day in November, 15 billion for the month. Michael, I know your business in Q3, you're running one of the largest loan books, in the space, over 5 billion in originations. Sam, I apologize, I actually don't have your numbers in front of me, but from everything that I hear, volume is just running through the roof. You're rolling out products like nobody's business. It's been a banner year for just about everyone. I know people get asked this a lot, but I'd like us to make some predictions here for the audience. So when you think about, you're all running businesses in this space, everything's kind of taking off like a rocket. When you think about the market size and the opportunity of your respective sectors in a couple of years, what are the benchmarks that you use to kind of size the opportunity? And where do you think you're going to be at, let's say 3 or 5 years out from today? And I'll just go down the line. So Michael, I'm actually going to pick on you here first.
Awesome. I was hoping you'd pick me first. I wasn't. I think the easiest way folks kind of look at the various opportunities from an asset class, lots kind of the Bitcoin gold comparison, right? I think that's the natural one that everyone is kind of buying into. And certainly it's interesting, our affiliates at Grayscale and the kind of their drop gold campaign, seeing kind of the price of gold kind of dropping as kind of the price of Bitcoin is appreciating and kind of whether the narrative is playing out. And then you have these banks, these research houses are saying that narrative is actually playing out at the moment. We'll see from a longer term trend whether that's possible, but here we are, the asset class, call it just focusing on Bitcoin for a second, I did 350 billion, gold is 7 trillion, 8 trillion, something like that. So in terms of where we are, obviously, even if you get to like a fraction of, the 10-20% of gold, you get to like really like just multiples of where the prices ultimately is today. But let's come back to access for a second. How do we get to even that? And certainly we talked about kind of the exchanges and the prime brokers and all of it. And, and kind of the lack of banks kind of participating in the space, within the next 2 years, I'm relatively confident we'll have a Bitcoin ETF. It's certainly in the United States, and I think that's kind of the ultimate access product for a U.S. investor to kind of get their exposure to kind of Bitcoin at kind of the net asset value every day. And certainly, if there is a Bitcoin ETF in the United States, the biggest banks in the U.S. will be supporting that product kind of in some capacity, whether that's on the custody side or as a market maker of the ETF or as an authorized participant in the ETF. By then, they will have figured out all the distributions. They will have figured out all the things that David has said, hey, let's figure out the AML, let's figure out the KYC compliance. And I agree with David. None of this other stuff, is all that complicated from a technology perspective. I think all the pieces are there. Frankly, I'm skeptical when I hear bank CEOs saying that they don't see the demand. I don't think that's true. I think every single one of them do it, but they can't talk about it really because they don't have a product to sell them, right? Like there's no way like these guys are going to come out and say, hey, Bitcoin is great, but currently I don't have my bank labeled fund to put you in. So they have nothing to sell you. So they're not really going to like talk about it all that much until they do. Then all of a sudden the floodgates are open, pent up demand, this, that, and the other. So I do think that, in the next couple of years, we'll have that ETF. I think all the banks will be participating. And I think that, I'm still firmly in the rising tide lifts all boats campaign. And I think the asset class and kind of the opportunity really kind of hits the, what I'll call, we always use baseball terminology and we always talk about the early innings and how early we are. I think the ETF is kind of what brings us into probably like the middle innings as kind of the next gating item to kind of take us to the next phase. But to say we're late in the game, we're a long time away from that.
So Michael, it sounded there for a second like you might be suggesting that banks aren't acting in the best interests of their customers. I know that's not what you meant to say there, but
I might have, but without picking on specific banks, obviously what the banks are really good at though is making products, right? They're really good at coming up with products to put their customers into. And for now they don't. And so I think there's still a little hesitancy to kind of put it, but ultimately though, if the demand is there and their bank isn't providing it, they're going to go elsewhere, right? To kind of get that exposure someplace else. And so, I think that at some point they're turning away enough customers and seeing other people make the money, and kind of grab that new customer base, that it'll make sense to kind of bring some of the stuff in-house and be able to put them into their own kind of bank, Bitcoin product.
Absolutely. All right, Sam, I'd love for you to talk a little bit about the future of your side of the business. We have barely even talked about two of the most interesting topics here, which is the eclipse in volume of the derivatives versus the spot market. And also, you've got this background here, Serum, which is, of course, FTX's decentralized exchange. Could you talk a little bit just about how you see the future of derivatives and also decentralized exchanges in the space? Just keeping in mind, we've got about 7 more minutes here. So if you could keep it 3 minutes, that'd be great.
Yep. So on the derivatives side, ratio of derivatives spot volume is, 2 to 1, 3 to 1 or something in crypto right now. And you see similar things in traditional finance. So I think that we've sort of, I don't know exactly where it'll end up, but I think we've sort of achieved the a reasonable ratio of those right now. I think that in terms of exchange volume in general, I sort of think about it 2 different ways. One is assume that crypto, the industry, stays about the same and look at sort of horse race jockeying of different participants. And the second thing is, where could the industry end up? And so in the first one, when I look at FTX and sort of make projections, obviously who the fuck knows, but we've been growing a couple 100% year on year relative to other exchanges in the space. And I think that obviously you can't sustain that forever, but it's sort of clear what the quote unquote goal is, which is get to roughly number 1-ish by volume, right? And so I think you can kind of draw out that roadmap, and it's just not that shocking of what that would involve. It's sort of the obvious stuff. But there's a second thing of what could happen to the space in general in terms of exchange volumes and derivative volumes. And I think the basic answer is and you can look at what gold or oil trade as sort of one next benchmark to get to, and you can get a good factor of 10 or 100 out of that, and then you can look at what S&P 500 futures trade at as sort of not the biggest number you could imagine, but the realistic that's sort of the biggest volume that we see anywhere, basically ignoring treasuries, which I think is sort of a different type of beast. And then you have what 2 or 3 orders of magnitude of growth that you can potentially get, and so I think that looking forward for volume growth, that's the kind of thing you could imagine. And obviously also getting, right now it's basically all futures volume for derivatives, but adding in options and other structured products, ETFs are a big thing in the rest of the world. So I think that's sort of one set of things. And then you can also look at right now I think volume in crypto is way more retail-y than it is in the rest of the world. And in particular, I think the role that pension funds play in the rest of the world doesn't really exist right now in crypto. And that's sort of the standard, not quant firm, but institutional flow coming ultimately from retail. And I think that that's sort of the big thing that's missing right now from crypto, or at least mostly missing. And I would guess that both Mike and David, I think from their businesses, are really eyeing that as something that would be a pretty natural fit for what they're building out. And so I think that that's a huge growth area.
Awesome. Sam, I apologize. I've got to cut you off there because we're about to run out of time. But I want David, I want to hear from you a little bit as well, just on give me the future of LMAX, give me the future of spot market volumes.
Michael, right? Everyone knows about volume, size of the market. Okay, 3 years from now, crypto will trade 5 times what it does right now. I think we look at total crypto volume around 30 billion a day right now. That's a fifth of gold. It'll overtake gold within 3 years. I work in a foreign exchange environment. LMAX Group operates 4 exchanges in foreign exchange. It trades $6 trillion a day. Crypto today is 0.5% of the FX market. It's not beyond belief that it will be 5x, right? So 2.5% of that market within 5 years. I think that's a certainty. And again, I'm saying 1% of $100 trillion under management will trade crypto within 5 years. That's 3 times the Bitcoin market cap today. So I think that's inevitable. And of course, we'll maintain our position. LMAX Digital will maintain its position as the #1 institutional exchange in the crypto marketplace.
Perfect. All right, guys, thanks. I apologize. Usually we try to leave room for audience questions, but really I just couldn't bring myself to cut the conversation short here. So I'm looking at a list of questions that people didn't get to ask. If people want to get in touch with any of you, your companies, what is the best way to do that?
First name, last name at lmax.com.
Perfect. Sam?
First name at ftx.com. Twitter or Telegram or support at ftx.com are probably the easiest ways.
Likewise, Michael Moro on Twitter, and I'm first initial last name mmoro at genesistrading.com.
Excellent. All right, guys. Well, thank you so much for volunteering your time today. Sam, I'm sorry I cut you off there a little bit at the end.
Nah, I was rambling anyway.
It was interesting stuff, man. I'm sorry we've got a hard stop at 1, but guys, thank you so much. This has been such a fun conversation. I know you've given our audience a lot to think about. Again, a big thank you to LMAX Digital. David Mercer is, of course, the CEO of LMAX Group. A big thanks for making this conversation possible. If you haven't checked them out yet, guys, definitely encourage you to go head over to their website, which will be in the email that we send out after this. If you're interested in this chat, we've got another one coming up on December 8th, which is we've got Dharma Capital speaking about the liquidity solution to institutional staking on ETH 2.0. For all you institutional holders of ETH out there, this is one that you definitely don't want to miss. Guys, thank you so much for what's been a really fascinating conversation. I have really enjoyed it and I appreciate your time. I hope it was valuable to the audience as well. Thanks all. We'll see you soon.
Thanks,
Thank you.
everyone.
Bye.